Hey everyone, so today is the conclusion of ranking my investments from 14 to 1. And today we're doing numbers 5 to 1. So we're going to get to find out what number 1 is right now. And I've been using this new method of like an expected return, factoring in risks methodology. I learned this from a book called Thinking in Bets. And actually my friend explained a lot of this to me. So Justin, thanks mate for getting my head around this idea. And I think it's a fun way to compare my investments, even though they're in different industries. I can compare them in expected outcomes and expected returns from here over the next 5 years. I can't do much more than 5 years because it gets really hard to predict. Can't predict the future anyway, obviously. I'm not very smart, but just 5 years, I feel a little bit, I can get my head around the next 5 years. I can't get my head around 20. Let's just keep it at that. So a quick recap in the rankings so far. We've had Dropbox at number 14. We had Alibaba at 13. That was before the big price drop for Alibaba. So maybe Alibaba would push inside the top 10. It wouldn't push inside the top 5, I don't think. But anyway, it's number 13 when I did this for Alibaba. Number 12 was KPG. Number 11 was OTCM. And then in the second video, it was number 10, Markel. Number 9 was Skyworks. Number 8 was TerraVest Industries. Number 7, Berkshire Hathaway. Number 6 was Prosus Naspers. Prosus Naspers share price has fallen since even recording that video as well. So maybe they would push inside the top 5. I don't think it would get to number 1, but there's a little bit of adjustments need to be made here, but look, whatever. Let's go find out what 5 to 1 is. And then at number 5, we have SDI Group, a very recent addition to the portfolio. I think this has a very low risk of taking a loss in this one. It's a diversified serial acquirer with a solid track record and a great CEO in Mike Creedon. I followed this company for quite a while. I've interviewed Mike on my channel a little while back, so if you're interested, take a watch of that video. They're just following the serial acquirer's playbook, which I'm really interested in. They're being decentralized with good organic growth, and I think Mike is a smart capital allocator. And I think what got me over the line in this investment was that mostly the free cash flow from now on is going to be used for acquisitions. The dilution that they had been doing is at this inflection point where the cash flow and maybe a little bit of debt can fund the acquisitions without needing to use the equity markets now. I think that's how serial acquirers can get caught, is in the early days, they have to dilute themselves. They have to issue stock. And if something goes wrong with the stock price, or you have to rely on people not dumping the stock. So they've gotten through, SDI Group, I think, have gotten through that point now, and they don't have to go to the market. They can use their own free cash flow now to continue growth, which is great. It means a lot of the risk, I think, is off the table. But of course, there is still some risk here. And the big one, I think, is key man risk. See, finding good people to run these subsidiaries, that's really hard because scientific instruments is quite a unique world. If a handful of their subsidiary CEOs left maybe at a similar time, it might cause some bad hires and bad results for the group. That's what I have to continue monitoring in this business. And that's essentially what you have to monitor for all serial acquired companies, especially while they only have maybe 20 or less businesses. When you start looking at things like Constellation Software, when they're in the 700 acquisitions that they've made, you don't have to worry too much about that anymore, but you also don't get the upside that I think you can get in something like SDI Group. So anyway, I digress. So anyway, if that bad situation happened, I think that's my 1x scenario, and I decided that's a 25% chance of happening. That's quite high, I think, quite a high chance of happening. I probably should put this a lot lower, but you never know, and the future's hard to predict. So giving it a 25% chance is quite conservative, but I think I'm somewhere in the ballpark there of the outcome, that likelihood of happening. So getting back to a double, though, seems likely, as the growth rate historically has been sort of 20-25%. And even with macro events happening, I think it's likely to get like 15% at least based on the acquisition multiples that they're paying. Mike is very disciplined in the acquisition prices. So a double seems, again, essentially the status quo continuing with macro stuff not being super dramatic. And if we wanted some multiple expansion and strong organic growth continuing, I can see a scenario of a 3 and a 4x here as well. So anyway, here are my outcome probabilities on the screen. We've got that 40% chance of a double, 20% chance of a 3x, a 10% chance of a 4x. Obviously, it's less likely to get a 4x than a 3x, and less likely of those happening than a 2x. So that's how I did that. I think there's a 5% chance of a 0. Unknown unknowns, something bad happening in England and the businesses. I don't know. It's hard to predict. Unknown unknowns. Yep, stuff like that. And then that 25% chance of a 1x. So my expected return factoring in the risks, and I think I've been pretty generous with the risks here, is a 2.05x return. It's about a 15% compound annual growth rate. And in at number 4, we have Judgement out of Japan, and it's been growing using this acquisitions and organic growth method that the CEO Joe Hirayo would be. I think would be considered like an outsider CEO of Japan. He has put this solid plan in place to grow, solidify the business in the medium to long term. They were doing really well until COVID slowed them down, but 2022 results have looked really strong again. Judgement, it's not quite a serial acquirer as the others, but there's definitely some serial acquirer elements here. What they do is they acquire and grow website properties in Japan. And the Japanese market, I think, is large and pretty attractive for Judgement, especially for a sophisticated acquisition model. They're planning to reach this 35 billion yen number by fiscal 2026. That's in their plans, which would be about a 20% per annum growth number from here. And I'll be conservative and think that they fall a bit short of that. And without multiple expansion, that should still be a double. And I do see a chance of greater than this with some multiple expansion plus actually hitting their targets. So they have no debt, so it's very hard to see a 0 case scenario. But being in Japan and being in internet properties, the unknown unknowns are higher than something like Berkshire Hathaway, of course. Anyway, so here are my outcomes on the screen. We have a 20% chance of a 1x, 40% chance of a double, 20% chance of a 3x, 10% chance of a 4x, and a 10% chance of a 0. Factoring all those risks gives me a 2.1x return, which is about a 16% compound annual growth rate. Okay, now we're getting into the top 3, and in at number 3 is Teqnion. Another one of my more recent investments. Teqnion is in Sweden. It's yet another serial acquirer. There are other options in the world, like for serial acquirer businesses that I could invest in, like Lifco, Indutrade, Lagercrantz, Instalco, Nibe, many others. But I chose Teqnion because of essentially Johan and Daniel, the CEO, and Daniel calls himself the CXO, which is, it's not a CFO, it's like a second in charge / strategy guy of the business. They're really great guys though. They're really solid people, and I do have a lot of trust with them, and they're going to run the business really well for the future, and they're going to do at least the best they can, and that's all I can really ask for. The business has been growing at well over 20% now for quite a long time. And the only issue I see happening is if maybe something disheartens Johan and Daniel and they leave or they're pushed out by the board or something like that. But it has been like 100 bagger since inception. So I think that's pretty unlikely. Everyone should be very happy with how these guys are running the business. So unless they get pushed out for whatever reason, or Johan's the soul of this business. So essentially, I think if he's out, I would be out. So I think that's the risk here, and that's how I'm thinking about it anyway. They're very diversified across, I think, 24 different companies now. They just acquired one, I think, today when I'm recording this video. They're across very solid niches now in multiple countries. The risk is very low, like a table with like 23 legs or 24 legs on it. A few of those could break. The table will still stand fine and still function as a table. Plus, they continually add more legs to the table. So, and at really attractive rates. They have very disciplined acquirers, really following the serial acquirers playbook very well. I just hope they continue doing it. So more of the same, maybe even a bit of a slowdown in the acquisitions, and maybe even a slowdown in the organic growth, and we easily get a double from here. No multiple expansion needed for that double. I see upside above that with better organic growth. Or even just the organic growth that they've been getting, as well as just the normal acquisitions, just a bit more awareness of this business, and they can get 3 or 4 times returns from here in the stock price. Look, unknown unknowns are still a thing, macro issues, of course, but even then, the businesses are in different niches. They have experience to handle recessions. They've been through them before, but maybe they can't handle something insane like, I don't know, a Russian nuclear attack on Sweden or something crazy like that. Very hard to predict that type of stuff. There's always a chance something unforeseen happens, and I think I'm factoring that in here to the price. So I think there's a 50% chance of double. I think there's a 20% chance of a 3x, a 10% chance of a 4x, that 5% chance of a 0, something going really dramatically wrong, and a 15% chance of a 1x. Gives me an expected return factoring in these risks of a 2.15x, which is a little over 16% compound annual growth rate. All right, so in at number 2, we have Trulieve. Trulieve recently won one of 2 licenses to produce in this state, Georgia. They're going to start with 5 dispensaries there and grow from that based on the demand. So that's another market for them to expand into with very little competition. Now, as they optimize this Harvest Health transaction that they did last year, I think their earnings per share get stronger. But growth here is going to be all about the licenses that they can get and having tight, disciplined operations. Trulieve have been good at this so far, but the track record isn't long enough, and I'm just not as confident with management as I am with any of the other businesses that I've mentioned so far. I also don't really like business-to-consumer businesses. It just gets competitive, even though the licenses make it tough for competition to come in. And I also just don't like the political nature of cannabis either. Anyway, on the plus side, debt is quite low and manageable. I think their cash in the bank is decent. Cash from operations was looking good before the Harvest Health acquisition, but that was always going to take a few years for them to cannibalize and merge into Trulieve. I think essentially there's just a lot of growth potential that is pretty easy to see developing. More states are opening up all the time. More states are seeing the money being made and the support from the people. I think it's 91% of Americans now are fine with legalizing marijuana. I know this is a bit of speculation, but it seems just far more likely that things will improve in the industry. And demand would just have to fall like really dramatically for the valuation to be around the price it is today in 5 years' time. Anyway, this is how I've calculated it. I've got a 35% chance of double, a 15% chance of a 4x, a 10% chance of a 6x. Getting those that 4x and 6x returns here, we're talking things like recreational use being allowed in Florida, more states opening up. It doesn't take much to easily see a double or a triple even overnight with a good political decision going our way, and it seems to be leaning that direction. I know that's speculation. That's why I've had to say a 20% chance of a 0 from here and a 20% chance of a 1x from here. So that's essentially nearly like 40% of my possible outcomes here are very bad for us investors. But even understanding all of that and adding in those risks, we're getting a 2.3 times return from here. That's about an 18% compound annual growth rate expected. Yes, it's higher risk. I get that, but it's higher return as well. Now, in at number 1, we have Redbubble. Yes, Redbubble. I know this is a very surprising number 1. It surprised me, actually. It surprised me a lot when I was doing this. And I think it's just mostly because of how cheap the stock has gotten in relation to the fundamentals of the business. There are still many things that can go wrong, and I know they just reported. I made a video a few weeks ago. They've reported since then. Look, it is ugly at the moment. I get that, but let me explain. So, high management turnover and poor financial control, serious macro factors, a bad culture internally eating away at the foundation they have built. I'm saying that these things are happening, and there's even a 40% chance of some of these things happening. I actually don't think that they have high management turnover, though I haven't shown that yet. I don't think they have that poor financial control. Yes, they've been losing money for the last year and a half, and macro factors are at play here a little bit for them, but let me explain why I think that even though I'm factoring in 40%, I still think that is more unlikely. Now, the founder has been buying more shares all the way down to the lows, which is one sign of confidence. Now, let me explain why I think this deserves to be number 1. So the SEO rankings for Redbubble are actually pretty solid, and traffic numbers actually have been picking up. They're reasonably okay. It's been a lot more resilient than most people would think. Etsy have shown this as well. Amazon have shown this as well. E-commerce is here to stay. It's not going to fall off a cliff. People still buy stuff online. It's still far more convenient than the alternative. And their SEO rankings, which is very important for them to keep the traffic numbers up, have been very solid. There is no decline in their SEO rankings. So, they don't have any debt. They're sitting on about $60 million in cash. It was $80 million, and now it's about 64 or something million in cash. The market cap is like I think it's like 150 million. It might even be less. It might be 120 million. That's the market cap. Look, the business is a really asset-light business, so they don't have to write off inventory or anything like that. Expenses have gone up recently, but the plan is for those to be stable now, as the hiring should be finishing in the next 12 months. Revenue is still coming in pretty strong. It's not as good as it was when the lockdowns were happening, but it is far better than it was pre-pandemic. But there are plenty of things that need to be cleaned up, and I'm only going to try to predict out 3 years on this because it's just a lot harder going out any further than that for Redbubble. This is more of a turnaround situation, and it is a bit more short-term in my mindset on this one. And I would not be making this investment today at anywhere near the same price that I paid last year, obviously. But at this price, at like 50 cents a share, I think this is really interesting. So the percentages that I've chosen are, I think there's a 20% chance of a double and a 20% chance of a triple. That gets it just back to $1.50 a share, which it was not that long ago. 15% chance of a 4x, 15% chance of it going to zero, a 10% chance of it getting cut even half again, so like even worse, 15% chance of it just hovering around the same price, and 40% of the outcomes are pretty bad, pretty ugly. But I do think the fair value for Redbubble is probably somewhere around 1.5 times their sales. See, a network effect businesses they're really hard to get going. And Redbubble has good traffic and they do have a little ecosystem going on here. And if they were at 1.5 times sales, right now, that would be a 4x return right now from the current price. It's actually getting close to 5 times. So in 3 years' time, I think some good news comes out about Redbubble, like some growth or strong free cash flow or something like that. And 1.5 sales is on the table. I can actually see a scenario where a 5x, 6x happens because they do show some signs of growth and they turn the corner. Plus, they're going to hopefully have a leaner business with some margin expansion and the market just realizing that this is actually a decent company. Well, then that 1.5 sales number from a higher sales number in 3 years' time gets us well above a 6x return. But I'm not even going to include that scenario. So based on my outcomes, that gets us to a 1.8 times return, but just in 3 years. So that's approximately a 22% compound annual growth rate. Now, I think it is funny that I did this exercise because if you were to tell me before I started doing this, which 2 businesses I like the least in my portfolio, I think I would have said TrueLeaf and Redbubble. But because the prices and my understanding of these businesses, I think they have strong returns, even factoring in those higher risks. Now, obviously, the issue with all of this is I might be wrong. It's art, not science. Even though I tried to be as accurate as possible, I have really tried to think carefully about the outcomes and the likelihood of each. I use my discounted cash flow calculator to help figure out scenarios as well. I read the financial statements and carefully read the commentary from the management. In one case, I even flew to Sweden to meet the CEO. Now, as I continue to learn more about the businesses, I'm sure I'll go and adjust these outcomes. This is what I have right now. And maybe this has helped you think about your investments and your portfolio. Now, what I'm going to work toward is businesses that I think have strong returns above that 15% based on these types of calculations, and outcomes that have really low 0 and 1 time, like 1x return outcomes. Because if I'm going to be wrong anywhere, it's going to be misunderstanding the likelihood of the downside. Now, regarding brokers, you should think about the risk you are taking there as well. Interactive Brokers, I think, has, say, a 1% chance of losing your money, whereas I think Robinhood and Trading 212, I think that's more like 5%, maybe even higher, and that makes a really big difference. Link in description for Interactive Brokers where you can take a demo account for a spin. That's the one I use. I highly recommend. We already take plenty of risk when we're investing. We don't want the broker going bust, so we got to keep that risk as low as possible. I have other interesting things in my description as well if that's of any of those things interest you, like my Discord group or my e-magazine, or lots of interesting things in there. Tell me in the comments as well any of the criticisms that you have. I can take it. I hope you've enjoyed this little 3-part series, and if you'd like me to do this again next year when I've got new information, please let me know. I'd be happy to do it again. It's a good exercise for me. Hope you've enjoyed. Back to regular content in the next video, and I will see you then.